Chapter 17, Investment and Business Brokerage. In this chapter, we're going to learn some investor lingo. We're going to explain the advantages and disadvantages of using real estate as that investment vehicle. We're going to describe some of the tax benefits of real estate investments and the effects of the New Jersey Uniform Commercial Code, which regulates the sale of businesses. Um, let's start off by talking about some of the advantages of investing in real estate. Well, some of the advantages are to generate a return on your investment, number one. Uh, using leverage. Leverage is using other people's money to buy real estate. It's what rich people do all the time. They never risk their own money. So that's the thing. We think we always need the money in order to get involved in investing. Got to save up and use some of your own money. No, use someone else's. Risk someone else's money instead of your own. So inflation, and we're going to learn about using inflation as a hedge. Because what does that mean? Well, property values just fluctuate. They go up and down, up and down. They've got their cycles that they go through, right? And so use inflation as a hedge. You buy low, sell high, right? You don't buy high, sell low. That's a good way to lose money. So as property values go up, simply by holding on to them long enough for the property values to appreciate, and then you dump it and get your riches and walk away, right? Some of the disadvantages of real estate as the investment is it's not highly liquid over a short period, meaning you can't buy it and sell it quickly without taking some sort of a loss. Unlike stocks and bonds, where you could buy them in the morning and then an hour later they shot up, and they're up and down constantly. It requires expert legal and sometimes tax advice. And there's a high level of risk involved if you don't know what you're doing. So let's do some highlights there about the return on investment, what leverage is, and that real estate's not highly liquid over the short period of time, meaning you're not going to buy it today and sell it in the afternoon, or buy it today and sell it next week even for a profit. Without taking some sort of a loss, because property values don't appreciate that quickly, right? The quickest way you could get it to appreciate is to do some sort of improvements and then flip it. But even with that, you're not going to be doing it in a week. It's going to take a little more time than that. So let me go and you got those highlights, if you will. Everybody got those highlights, I'm guessing, by now?
Yes.
Okay. Did say let me know, please. Okay. The ways that real estate investment can yield return is property can be held for appreciation using inflation as a hedge. Generally expected to increase in value over time to show a profit when you sell it at some future date. Income properties held for producing rental income as well as for profit on its eventual sales. You generate cash flow if you rent it out, right? You get spendable income after expenses. That's what cash flow is. You could do some pyramiding through refinancing, draining out the equity to use it as a down payment to buy more real estate. And if you do this, you could find yourself owning millions of dollars of property in a relatively short period of time. But it's all going to be highly mortgaged. And equity. Equity is the difference between the market value and what is owed on the property. So let's do the highlights. Cash flow, page 328. That's spendable income. You want that cash a flowing, right? Spendable income, cash flow. Spendable income after expenses. Nice. All right, some of the tax benefits from the sale of your primary residence. You should always refer queries to accountants or people's CPAs or tax attorneys. But we do have knowledge about some items, like both the federal and state government have exclusions from capital gains taxes on the profit of your primary residence. We learned this in a much earlier chapter, like chapter 8, I think. So if you own and occupy your primary residence for 2 out of the last 5 years before you sell it, if you're a single filer, you could deduct up to $250,000 of capital gains tax, $250,000 of income off the sale of that property. You get a capital gains tax exclusion for. And if you're a married couple that files your taxes jointly, you could get up to a $500,000 capital gains tax exclusion from both state and federal income taxes for the sale of your primary residence. What does that mean? It means if you sell your property up to a $500 profit out of it, you pay zero in state and federal income tax. If you lived in that property for 2 out of the last 5 years before you sold it. Now, if you sell it before 2 years, the IRS does consider some exceptions where you could still get that capital gains tax exclusion if you were forced to sell due to a hardship. And the IRS classifies hardships as being, let me see, what is it? Job loss or transfers. You're forced to sell the home early in those situations. For health reasons, death, divorce, or multiple births. And you could use this deduction as often as every 2 years for the next property and the next property that you lived in for at least 2 out of the last 5 before the sale. Now, of course, sellers must pay income taxes on the profit from a sale of any investment property, but we're talking about your primary residence here. So your primary residence, you could get a capital gains tax exclusion of up to $250,000 for single filers and up to $500,000 for married couples filing their taxes jointly. Okay. Well, you need to know that. So we will highlight that again somewhere. Somewhere it's coming up. Well, actually, no, we already had that in an earlier chapter. We had it in our notes. So it's actually not coming back here again. I just brought that up because we're going to be talking about how you could save money on the commercial property sales. So that's why I brought this one up again. This was from chapter 8 or 9 when we did the taxes. Okay. All right. Now, if you're selling a commercial property, there is ways that you could avoid paying taxes, those income taxes on the profit of the sale of your commercial property or your investment property. It's called a tax deferred exchange, or Section 1031 in the IRS tax code. So we call it a 1031 exchange. Let's do the highlights over here, and then we'll move on to the next one. Just give me 1 second. I got to run down and get another drink. I'm out of my coffee and I did not bring another drink up. So let me pause this. Okay, so 1031 exchange is my own slide with just the highlights on it here. And if you're selling an investment property for a profit, you have to pay income taxes on that profit. Through a 1031 exchange, also known as a like-kind exchange or a tax-deferred exchange, if you sell your investment property and then you reinvest that money into buying another like-kind investment property, you can avoid paying the income taxes on the sale of that property for the profit of the sale of that property if you reinvest that money into another investment property. And this is the way that you do it. First of all, you should have a tax professional involved to do the communications with the IRS for you. Unless you know which forms and you're familiar with doing it, but I would suggest having a tax professional involved so you do it as a team. So a 1031 exchange allows an investor to defer paying income taxes on the profit of the sale of that investment property if they reinvest it in a similar like-kind investment property. They would have to pay income taxes until they eventually cash out. They don't have to pay income taxes until they eventually cash out and realize that profit, that capital gain, when they sell it off. Now, in order to avoid paying the taxes now, strict timelines must be followed to qualify for the tax deferment. So we need to be aware of this. Otherwise, our clients could lose the tax deferment if we don't follow these strict timelines. So you got to get a tax attorney or CPA to communicate with the IRS. You must notify the IRS that you're going to be doing an exchange at the time of the sale of the current investment property. And then the IRS will give the investor 45 days to find another replacement investment property that they wish to purchase after they sold that first property. And then they give you a total of 180 days to close on that purchase. So it's not 45 days to find a property plus another 180 days. It's 180 days in total. It's just that within the first 45 days, you have 45-day deadline to find a replacement property and then 180 days total to close on it. Otherwise, they could lose that tax deferment. So we just need to be aware of those strict timelines that we need to follow. We're in a rush. And if you don't meet these deadlines, the IRS will not allow them to have that tax deferred exchange, and then they'll have to pay the income taxes on the profit of the sale of their initial investment property. So boot is what we call the difference in value when you're selling an initial property and the investment property the replacement property that you're buying costs less than the one that you sold. That difference in value is known as boot. It's a capital gain. So boot is loot, and all loot is taxable. Okay, so that's a little saying I have there for that. So boot, when the replacement property costs less than the sold investment property, the difference in value is known as boot. And boot is loot, and all loot is taxable. It's like the pirate's booty, right? But you got to pay taxes on it. It's the capital gain. Okay. So here, let me just let's do some highlights, and then I'll show you we'll do a little math on this to figure this out. So capital gain is taxable profit on the investment, and a basis is the investor's initial cost to buy whatever their investment is. In this case, it's real estate. But this is some of the investor lingo that we're learning here. Capital gains and what a basis is. And we're also going to learn what an adjusted basis is. A basis is like your base price of buying the property, And then the adjusted basis is you also add up any additional money you put into that property to fix it up. That's all your investors' money that you have in that property. So when you eventually sell that property, you could deduct your cost to purchase it plus the money you put into it. And then whatever you get over that in the sales price, that's your capital gain. That's your taxable income.
Got it.
Yeah, go ahead. Go ahead.
No, I got it.
Okay. Did you have a question?
No, it's just for the slide that we're done highlighting.
Oh, okay. All right. Thank you. Okay. So the 1031 exchange and the boot, how does this work? Well, the basis is your initial cost to purchase. So let's say in this example, you have a base price of $300,000 to buy this investment property. You put another $100,000 into it for improvements. So you add the improvement cost to the basis. This is known as the adjusted basis. So you're all in now $400,000 into this property. If you're able to sell it for $600,000 and you do nothing, you don't buy another investment property, you don't reinvest it, you're basically cashing out a $200,000 capital gain, right? So as you can see on the right side, then you're going to be taxed for the profit of that sale of $200,000, not the whole 600 because you put 400 into it. So you got to subtract the money you're into it from the total sale price, and then you'll be left with the taxable income or the capital gain of $200,000. Now, if you were to reinvest that entire $200,000 into another like kind investment property, you don't pay any income taxes, any capital gain taxes on it. In this example, though, you sold it for $600,000, and then the replacement property that you bought is only $500,000. So you didn't reinvest the entire $200,000. You only reinvested $100,000 of your capital gain. The other $100,000 you put in your pocket, you cashed out. And that difference in price is known as boot. And boot is loot, and all loot is taxable. So you're going to have to pay you're going to have to pay income taxes on that 100,000, not the other 100,000 that you reinvested, only the part that you cashed out on. Everybody got that? Okay. Depreciation. So boot, that term boot, you need to add to your definition list there, by the way. Depreciation, we learned, is a loss of value due to any cause or condition. In this chapter, we're going to learn that depreciation is an accounting concept to deduct the cost of an investment and any improvements on that investment property for taxation purposes. It's not an actual reflection of the loss of value on the property. It's used to reduce taxable income before taxes are computed. It's like you guys are going to become independent contractors as real estate salespeople. So any money you put into your business, you get to deduct that from your income to lower your taxable income. You guys follow me so far? So if you're investing in real estate, you could do the same thing. You could deduct the cost of that investment, the price of the real estate, from your income. However, you can't do that all in 1 year. Like, let's just say that the job you were getting was a plumber. You were going to become a plumber. And you need a van to carry all your equipment and supplies. Large purchases like that for machinery and equipment and vehicles and real estate, the IRS has life expectancy for these items. So you cannot deduct the cost of the purchase of that item in 1 year. You have to depreciate the value of that asset over a period of years. For vehicles, I believe it's 7 years. For real estate, if it's residential, it's 27 and a half years. And if it's commercial, it's 39 years. So a property's value cannot be depreciated or deducted all at once. The asset has to be depreciated over a period of years, whatever the life expectancy is as defined by the IRS. Now, the value of land cannot be depreciated, though, because land, as a general rule, does not depreciate. So here's a question. First, highlight this on page 330. And right next to the title, economic lifespan of an improvement, because that's how they usually use the wording on exams. If the economic lifespan of the improvement of the real estate is 27.5 years, there. Actually, I have an actual question here. If a property's estimated value is $500,000 and the land is estimated at $150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27.5 years? Okay. So do your highlights and write your notes. Let me know when you got that. And then we could work on this on the next slide. We'll actually do this problem. But first get the highlights. Let me know when you got the highlights. I'll switch the slide. Now, they even show you right here, only the cost of an improvement to the land can be recovered, not the cost of the land itself. And that's because land does not depreciate. Okay, everybody got that? Okay, so here's that question again. How do we calculate this? Well, first, you got to take the total value of the property, which is $500,000. And if the land is estimated at $150,000 and you can't depreciate it, well, then you got to subtract that from the total value to get the improvements value of $350,000. Now, if it's got an economic lifespan of 27 and a half years, what kind of real estate is it?
It's a house, residential.
It's residential. Commercial real estate, it's got an economic lifespan of 39 years. So we got to divide this by 27 and a half years. And then that'll give us how much money we could deduct each year from our income to lower our taxable income amount. And that comes out to $12,727.27 each year. So whatever our income is, we could subtract that from the total income and then calculate the taxes based on that lower income amount. But the question asks, what would it be if it depreciated over 3 years? So we just got to times that amount by 3, and that's the answer. So this is another math problem you'll probably get on exam. I don't think on a school exam, I think state exam. I got to add a question like this onto the school exam, though. Still working on building that database in my spare time, so trying to get more and more questions in it. You guys good? Got a picture snapped of this or whatever, so you have you know how to calculate this math problem if you get a problem on the economic lifespan of an improvement.
Got it.
Okay. So federal tax law limits the deductibility of losses from rental property. For the first $25,000 of loss, it could be used to offset income from any source. Investors must actively participate in the management and operation of the property. We refer to that as sweat equity. Like you cut the grass, you vacuum the hallways, you do some basic maintenance, you take out the trash, you do stuff like that. You got to have something in the game in order to get that deduction. And your income has to be less than $100,000 a year before that deduction is made for that property. All right, so tax credits are different than tax deductions. Tax credits can be more valuable because they're a dollar per dollar matching credit. So a tax credit is a direct reduction in taxes due rather than a deduction from income before the taxes are computed. So tax credits are more valuable than a tax deduction. And I put together a math problem I could show you on screen. Not that you need to know for exams, but I'll show you on screen so you could see the difference in the value of a tax credit versus a tax deduction. But a tax credit has far greater value. Investors in older buildings and renovations of low-income housing projects could use tax credits to offset up to $25,000 of other income. Even passive investors can take advantage of the tax credits. The maximum income level at which the credit can be taken is also higher. Investors with adjusted gross incomes of up to $200,000 are entitled to the full $25,000 offset, which is reduced by 50 cents for every additional dollar of income and eliminated entirely for incomes above $250,000. What do we have on this previous slide? Has taxable income less than 100,000 before the deduction's made. I guess it went up to 200,000. So let me go to that slide and make an adjustment there, because it is now 200,000 apparently. Okay. Tax credits have been provided for taxpayers for renovation of historic properties. Historic property is designated by the Department of the Interior and listed in the National Register of the Historic Landmark Sites. Or property of historic significance, like George Washington slept here or something of that nature. Located in the state certified historic districts. The allowable credit is 20% of the money spent on the renovation. The work must be accomplished in accordance with the Federal Historic Society guidelines and certified by the Department of the Interior. After renovation of the property must be used as a place of business or rented. It cannot be used as the personal residence of the person taking the tax credit. There is also a 10% credit of 10% of rehabilitation cost for non-historic buildings placed in service before 1936. Non-historic buildings must be a non-residential property. The law also provides tax credits ranging from 4 to 9% each year over a 10-year period for expenditures on new construction and renovation of certain low-income housing. So when we had the whole mortgage market meltdown and the arrogant, politicians trying to think that they could step in and fix the problem that they created by throwing more money at it, by offering tax credits to try to induce buyers to come out of the woodworks and purchase more properties. They actually made the problem even worse. But anyway, so this is another example where the government offered a tax credit. So tax credit is a direct reduction in taxes due rather than calculating a deduction from income before the taxes are computed. So once again, it's available to taxpayers who renovate historic property or non-historic commercial buildings placed in service before 1936. And sometimes the government offers tax credits as a stimulus, like when they offered $7,500 for buyers to rush out and buy a home, and then they did an $11,000 tax credit for another year after that. That was between the years of 2008 and 2010 that they offered these tax credits to incentivize buyers to come out and purchase a home. But there was a catch. The buyers had to live in the house for at least 3 years before they sold it. Otherwise, they needed to pay back all that money from the tax credit to the IRS. So when people rushed out to buy those homes, and then the property values started correcting, and after the end of the year, they started dropping like a brick again. People got out by doing short sales to avoid foreclosures. And when they managed to successfully do that, they had the IRS knocking on their door asking for their tax credit money back. The Big Short was that movie that shows you a little bit of what happened. Anybody watch that yet? Anybody get a chance to watch it yet? The Big Short? No. Check it out, guys. So it's real estate related too, and it's not bad. It gives you a little education too. Okay, so here I'm going to show you. I put together this slide to do a math problem so I could show you the difference, that a tax credit is much more valuable than a tax deduction. So in this example, we're gonna show you by comparing a $15,000 tax deduction versus a $15,000 tax credit. When somebody has an income of $100,000 and they're in a 15% tax bracket. So if you have income of $100,000, you minus that $15,000 from your income to get your total taxable income now. So this is your reduced taxable income. So now your taxes are calculated based on this reduced income amount. So if you're in a 15% tax bracket, now you're paying $12,750 in income taxes. Now, a tax credit, if you have a $100,000 income, you're in a 15% tax bracket, you owe $15,000 in income tax. However, you got a tax credit of $15,000, you now owe nothing. Because tax credits are calculated against your taxes due rather than calculated before your income. So here we can see the income tax, you do the deduction, and then you have the taxable income, and then you calculate your taxes. In a tax credit, you calculate your taxes first, and then you get the credit applied against that. So it's worth more. It's much more valuable. Okay. Land contracts are also known as installment sales contracts. We learned about this in several chapters, chapter 11, as well as others. It's a type of seller financing where the seller does not give the buyer the deed until the full amount owed is paid. So there are some complex tax rules involved, and it's figured on the investor's marginal tax rate. You should have a tax professional involved with you when you're doing these sales or purchases this way. Now, a real estate investment syndicate is a type of business organization. It's not a legally formed business entity. It's just when two or more people come together to carry out a business project. Like if you and I get together to carry out a project, we're going to buy a house, an investment property that we're going to fix it and flip it. When our project is done, our syndicate is done. Whereas a joint venture is the same thing. It's not a formally created business entity. It's when two or more groups come together to carry out a business project. When the project's done, the joint venture is done. And we also have real estate investment syndicates. It's a business venture in which a group of people pool their resources to own and develop a particular piece of real estate. So here's a little warning I put together for you as real estate agents. If you get the ideas in your head, because a lot of agents often do, after they're helping clients and they're learning and getting educated, and they learn about how all these people that they're showing properties, you start to get the eye of the investor. So you're looking for the helping investors find certain types of properties, and then you see what kind of properties they're doing, they're looking at, and you don't see it as a good investment, but then you see what they do to it, and then it's like, oh, now I see what's going on. So you get the eye of the investor now. So now you get the ideas in your head. I could spot these properties a mile away. I see them first. Why don't I just buy them and become the investor? Only if I had the money. And you get this idea. I got it. I'll advertise trying to get investors to invest in my project that I will own. That's how I could get the money. But wait a minute. If you do that, this could be classified as a security. And to deal in securities, you need to have special licensing to deal in securities. And you need to have a real estate license because it's also a real estate that is the object that's being traded here for security. And this is only when you're offering people a slice of the pie of the profits for a property that you own, not them. So this could be classified as a security. So special licensing is required. The project also needs to be registered with the FTC, the FEC, the Securities and Exchange Commission, and the New Jersey state covers these things under their blue sky laws. Now, such offerings must be there has to be a prospectus prepared warning investors of the possible risks involved, not just the upside potential of how much they could make off of investing in your project. So they need to put together this type of prospectus, and those people that have that special licensing to deal in securities, that's what they study, that's what they know how to prepare. Okay. General partnerships, we're talking about partnerships, business partnerships. There's general partnerships and limited partnerships. We went over this in an earlier chapter, 5 or 6, I think it was. No, chapter 7. In a general partnership, all members share equally in the managerial decisions. They share equal profits and losses, so they can be held liable for any additional debts the business takes on. And all members are general partners that work in the day-to-day business activities. Whereas in a limited partnership, there's always at least one general partner who organizes and operates the business and is responsible for any additional debts the business takes on. The others are merely investors that are not involved in the day-to-day business activities of running the business. They're called limited partners. They're limited in their liability to the extent of their initial investment, which is all they're risking, which is all they risk losing. They're not responsible for any additional debts that the business takes on. Okay. Mm-hmm. Okay, let me just check out what slide number this is. Okay, doke. Sorry about that. REITs are real estate investment trusts, and they get the same tax advantages as mutual fund investors. We also highlighted this from a earlier chapter. We skipped forward here. You probably already have that highlighted, right, on page 333. REITs, real estate investment trusts. These investors can get the same tax benefits as mutual fund investors. In order to create a REIT, there has to be at least 100 investors, with at least 75% of that trust income coming from real estate as the investment vehicle, though. For exams, who do REIT investors get the same tax benefits as? Mutual fund investors. Do you need to have a real estate license to sell a business? The answer is no. Not unless real estate's involved and you need to market the real estate for
In
sale.
there. Sorry, can you please go back one slide?
Sure. Okay.
Thank you.
You're
What
welcome.
are these two? He didn't account for these two.
All right. So business opportunity sales. You do not need to have a real estate license to sell a business unless real estate is involved in the sale. Remember, with commercial real estate, we're dealing with businesses, so it's commercial real estate. Attorneys prepare the sales contracts for those, but we do the marketing of the commercial real estate. So besides the title to the real estate or present lease, an attorney would be needed to prepare the sale or lease contract for these properties. Now, we usually start that process by preparing those non-binding term sheets and such. But when selling a business and a real estate's included, well, let's just look at if you're somebody selling a business and real estate's not included. What other things do you get in the sale of a business? So an attorney's needed to transfer these things from one owner to the next, like the trade fixtures, the stock and the inventory, business name and customer lists, goodwill, that's actually a thing all on its own, special rights such as copyrights, patents, franchise licenses, and franchises and picket licenses, other types of licenses that may be needed by the business, picket lottery machines, etc. All kinds of things like this can be covered in the sale. Now, we're going to get into this a little bit more towards the end when we start of this chapter, as we start talking about personal property, personal assets of the business that go with the sale. I'm going to give you some advice here on how not to break the law when helping someone sell their business. I'm going to show you how not to create a felony. And it's easy to get caught up in this if you're not familiar in what to look out for. So business opportunity sales, page 333, highlight that a person who sells or negotiates the sale of a business for others for a fee is required to be licensed as a real estate broker. The exception is when business is sold without any real estate interest in any form. In other words, do you need to have a real estate license to sell a business? No, unless real estate's involved. They just worded it kind of backwards there. How do we finance the purchase of a business? Well, you're going to need a substantial down payment, and the seller provides the purchase money mortgage for the balance of the selling price of the real estate. The business purchase requires cash or personal loans in order to buy it. Now, this is what we need to know. The Bulk Transfer Act is part of the UCC, the Uniform Commercial Code. This is a different UCC than what we studied about the Uniform Construction Code. This is the Uniform Commercial Code, which regulates the sale of businesses. The part that we need to be aware of is the Bulk Transfer Act, which regulates the sale of personal property in the sale of a business, that chattel. So the Bulk Transfer Act is designed to protect I want you to write the word sellers in there, the seller's creditors from the fraud perpetrated by a business owner who sells the business, including the equipment and stock, and then disappears, leaving creditors unpaid. If you assisted them in selling that business, you helped them commit that crime, that fraud. So how can we avoid that? Well, I'll show you in just a moment. Let's just first get this highlighted on page 334. And then we're going to go to the next slide, and I'll show you, I put together a slide just all about the Bulk Transfer Act. But who does the Bulk Transfer Act protect? The seller's creditors. That's what you need to know for exams. I mean, this page over here explains it all too. But I'll go through my slide as well. So, on page 335, the requirements of the Bulk Transfer Act are designed to protect the interest of the buyer as well as those of the seller's creditors in the sale of a business. Non-compliance with the law is a criminal offense in New Jersey, and real estate's not covered under the Bulk Transfer Act, just the business personal property, like all the machinery and the inventory, the stock and inventory that's included in the sale. Okay? So I wrote up here, the Bulk Transfer Act is designed to protect the business seller's creditors in the sale of a business. It also protects the buyer, but as a side effect, because they should be informed that all the inventory, machinery, and tools, the chattel of the trade, have not been paid for in full, and therefore can chase after the seller's personal assets to get reimbursed. It'll make a little more sense on the next slide. There we go. So this is what you need to know for exams. The Bulk Transfer Act is a part of the UCC, the Uniform Commercial Code, that prevents fraud in the sale of business chattel. It protects the business seller's creditors from the seller selling the business and its inventory and equipment, saying it's all included in the sale, but yet it's not been fully paid for yet because they've been financing it, or they've been given the stock and inventory on credit. Then the seller leaves their creditors unpaid. It's fraud. And if you help them sell the business and help them commit that fraud, you're also guilty of that felony. So the Bulk Transfer Act, the UCC, Section 6, Article 6 of the UCC, Uniform Commercial Code, is called the Bulk Transfer Act. It regulates the transfer of chattel when selling a business. It prevents fraud when the business is sold. It requires the business seller to make a list of all outstanding debts to creditors and supply that list to potential buyers. You should be making sure that they're doing this. And then notify the creditors that the business is for sale. So real estate licensees must ensure these disclosures are made to avoid assisting the seller commit a crime. In New Jersey, the Bulk Transfer Act protects the seller's creditors, but it also protects the buyers and their creditors, but kind of as a side effect. It's kind of like when you sell a house, right? Or when you buy a house. If you buy a house, are you required to get homeowners insurance? Well, who does it protect? Who does homeowners insurance protect?
The homeowner?
Well, the way to truly know this is ask yourself the question, who's requiring me to have homeowners insurance? It's your lender. The lender requires you to get homeowners insurance. Why? To protect their collateral, which is the house. So who is really benefiting from homeowners insurance? Who is it really protecting?
The lender?
The buyer's lender. Because if that house burns down, their collateral is secured. So it's really protecting the lender. Does it protect the buyer too, though? Yeah, but kind of as a side effect. And you really need to get a rider for your personal assets in your house for that insurance to cover all that stuff. So does it protect the buyer? Yeah, but as a side effect. It's mainly there to protect the lender. Eventually, when you get that loan paid off and you have homeowners insurance, then it protects the homeowner more, right? But in the meantime, the lender's requiring it, so it protects the lender. So in the same way, the Bulk Transfer Act protects the seller's creditors. Does it protect the buyer of that business and their creditors? Yeah, but kind of as a side effect. Okay? So real estate brokers may not draw up contracts for commercial property or the transfer of a business ownership. That's practicing law without a license. So only an attorney can handle those things. So what do we do when we're selling a business? We just market it and we find a buyer. And then we pass it off to attorneys to do the contracts and such. Okay? But for exam purposes, who does the Bulk Transfer Act protect?
Seller's creditor.
The seller's creditors. There you go. And that concludes chapter 17. If you guys want to snap a picture of that slide before I close it out, be my guest. And now let's do the key terms to review for chapter 17. So, key terms to review number 1. Cost plus improvements minus depreciation. The cost plus improvements of the real estate minus the depreciation.
Isn't that depreciation?
No, cost plus improvements minus depreciation is the adjusted basis. So 1 is A. An increase in value.
Appreciation.
Appreciation. 2 is B. Initial cost of the real estate. What do we refer to as the initial cost of the investment of the real estate?
Basis?
The basis. It's the base price. 3 is C. A document transferring ownership of personal property.
Bill of sale.
Bill of sale. Correct. 4 is D. Extra money or property received by one party in an exchange.
It's a boot.
Boot. Boot is loot and all loot is taxable. 5 is E. You guys starting to see a pattern starting to form on this page at all? Checking to see. A law regulating the sale and financing of business personal property.
Bulk Transfer Act.
6 is F. Taxable profit on the difference between the adjusted basis and the net selling price of an asset.
Capital gain.
7 is G. Starting to see that pattern yet?
It's going in alphabetical order.
They didn't scramble none of this up. Yeah. Money left from rental income after expenses are paid.
Cash flow?
Cash flow. You want that cash flowing. 8 is H. Yearly. This is horrible definition here. It says yearly bookkeeping charge for part of initial cost. They're looking for depreciation as the answer. That's a horrible definition, though. So 9 was I. Tax deferred mutual transfer of income property.
Exchange.
An exchange. And which exchange did we learn about? What section of the IRS tax code is that tax deferred exchange?
1031.
1031. Very good. 10 is J. Real estate held for rental income is known as
Income property.
income property. 11 is K. All right, so that's the end of key terms 1. Let's do key terms 2. Got to make a note here. Oh, no, I already have it. Okay, never mind. I'll make a note for them to scramble those answers up in the next version of the book. Okay, key terms 2. A law regulating the transfer of business personal property.
Uniform Commercial Code.
10 is A, correct. Refinancing property to buy more.
Pyramid.
Pyramiding, 4 is B. Direct deduction from income taxes due.
Tax credit.
Tax credit, 9 is C. Joining together of 2 or more people to carry on a business project.
Syndicate.
A syndicate, yep, 8 is D. A group pooling resources to buy real estate.
Real estate investment syndicate.
Yep, 5 is E. The rate at which investors' top dollars taxed.
Margarine tax rate.
3 is F, the marginal tax rate. Sale in which the seller receives purchase price over a period of years.
Installment.
What was that? I think you guys stepped on each other. I didn't hear it.
Installment.
Installment sale, 1 is G. Extensive use of borrowed money for purchases. What do you call it when you use someone else's money for your investment?
Leverage.
That's leverage. 2 is H. A fund making real estate investments and selling shares.
Real estate investment trust.
6 is I, the REIT. And they get the same tax benefits as who? Mutual fund investors. Cash flow plus income tax savings plus appreciation.
Return.
That's all return on your investment. 7 is J. And that concludes chapter 17. Yay.